China is potentially weighing the opportunity to pass a new US-style stimulus package over the next 12 months to spur growth in its rather lagging economy. Although China has not had a recession since 1993, their stellar growth rates of north of 6% have slowed down significantly, with expectations for 2023 hovering around 5.5%. And even that expectation looks really optimistic if you look at the real-time data coming in from youth unemployment as well as consumer spending. However, with the words that the government itself is saying about potentially supporting its own economy, there are some good reasons to believe that a bottom in the Chinese equity market and the consumer space is most likely already here. And that means good things for not only EV stocks in this industry, but as well as stocks like Alibaba, which have obviously been beaten down to a drum over the past 3 years. How exactly can we call a bottom in the Chinese stock market? And what can we truly expect from the upcoming earnings season, which is supposed to be one of the most important in the Hang Seng history? Well, folks, those questions are exactly what we're going to address in this video. But as usual, folks, before we get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. To start things off, folks, let's address the motivation behind this video, which is an article from the Wall Street Journal discussing BYD dethroning Tesla as becoming the largest EV player on planet Earth. And there's a couple of important reasons for why this is such a big deal. 5 years ago, nobody had even heard of BYD outside of mainland China, but now the company is on track to eat up Tesla's market share and outsell it, not only in plug-in hybrids, but actual full battery electric vehicles. This is happening at a time when most of the Western media thinks that the Chinese economy is in a massive recession and that there is a property crisis looming on the horizon. Well, folks, if BYD, which basically only sells in mainland China, is witnessing such rapid growth, far outpacing what we're seeing in the West by Tesla, then chances are the consumer is doing probably a lot stronger than many people think, especially given the fact that right now interest rates in China are much, much higher than they were 10 years ago. And that right there, folks, is exactly why Chinese equities are so much cheaper compared to those in India and in the US, and why there is a potential trade or investment opportunity existing in the space, even though, yes, I have said that for the past 2 years. Trust me, there really is no way to predict what the Chinese government is going to do, and that is not what I am trying to do as an independent investor. My goal is simply to take advantage of oversold opportunities that might be underlooked by investors right now and potentially result in FOMO or chasing in the very near future as we get rid of some of the distractions that are currently facing US markets. And first things first, don't forget the fact that the Chinese Hang Seng index as well as the internet ETF by CraneShares has actually already bottomed since October, which means markets right now are not actually performing as bad as our US equity markets, which, as we all know, were down almost 10% over the past month and a half. The pain that we saw in Alibaba, JD, and Tencent around the whole tech crackdown have actually resided. And right now, instead, we're seeing a sideways consolidation, which is much more reminiscent of a potential bottoming pattern. And the most interesting part is that last month, we saw the highest amount of fund outflows from Chinese equities over the past 12 months. That is a really important indicator of capitulation, which is something that typically precedes a bottom in the market. This doesn't mean that these markets are going to rally all of a sudden and that Chinese equities are going to outperform those in the US, but it does mean that the risk of holding these right now is much lower because of the lower valuation multiples. And this doesn't even consider the fact that the government itself wants growth in China and will do anything to support it. The only thing they really don't want is inflation, which is why they're proceeding so slowly with all their actions. And just over the past 6 months, we have seen a lot of positive developments in this space that signals the government potentially emphasizing stimulus in the form of monetary or fiscal policy. For example, just last week, the Central Huijin Investment Limited Corporation in China bought about $65 million worth of shares in 4 of its major national banks by the name of Bank of China, the Commercial Bank of China, and the Industrial Corporation. And they expect to increase their shares of buyback in these companies over the next 6 months. This move is extremely reminiscent of what happened in the US in 2009, when the TARP Act was introduced and the government started buying back bonds and shares of the regionally strapped banks. The Sovereign Wealth Fund of China has also had a history of intervening during times of extreme turbulence, like right now, where we're seeing the Chinese developer Evergrande actually go almost bankrupt and stocks in the space fall to more than a decade low. And let's be honest here, folks, what's going on in the Middle East and with Russia, geopolitics is not the main concern right now. China doesn't want Taiwan to go out of its control, neither does the US, and they're all going to make sure that this country stays as sovereign as it possibly can because it houses one of the biggest semiconductor manufacturers on planet Earth. If there were to be serious involvement from China and the US in this new Taiwan war, but there obviously could be repercussions for stocks, but not as much as many people think. Could some US listed Chinese companies get delisted in such a scenario? Absolutely. And will that cause some US investors to panic sell their positions? Absolutely. But as we all know, most of Chinese companies that trade on the Nasdaq and the New York Stock Exchange also have the equivalent counterparts trading on the Hang Seng Hong Kong index, which means you can transfer your ownership to that index without really any fees or any hesitation. In the short term, there will always be volatility, but it's all about finding value as long-term investors in companies that have proven track records of execution, and Alibaba and JD.com, for example, do certainly have that. The EV industry aside, something like Alibaba is trading at extremely good fundamentals with a valuation that nowhere near matches its US counterparts. This just so happens to be, in my opinion, one of the best value mega-cap stocks in the market, disregarding any sort of external VIE structuring issues. With profit margins and profitability better than something like Amazon, Baba is trading at a forward PE of only 8.9 with a price to cash of 2.5, which means the company has plenty of cash to cover any sort of debt it might have to pay over the next 12 months, which again really is important given the current economic turbulence in China. This is in perspective to something like Amazon's forward PE right now of 41, while having roughly the same year-over-year growth and worse profit margins. It'll be interesting to see whether or not China will go through with their stimulus packages and their budget deficit increases, but rest assured, some positive developments are certainly taking place in the Chinese equity markets, and certainly something to consider for investors who are looking to find some value in foreign companies. As usual, folks, thank you very much for watching. Let me know your thoughts on the situation down in the comment section below, and I'll catch you guys in the next one. Take care.